All right, we're going to be looking at Chapter 2, Analyzing and Recording Transactions. So again, like we've said before, Chapter 2 builds from Chapter 1. So don't forget what we've learned in Chapter 1 where we're analyzing those transactions. Remember that we have 2 accounts at least for every transaction. So let's get into a further dive for Chapter 2. All right, so the reason we're getting all these transactions analyzed is for that end goal of processing the financial statements and preparing them. So we want to make sure that our transactions and events are done in chronological order. And to do that, we're going to be identifying what the transaction is, which we've learned in Chapter 1. We're getting that information typically from source documents that are telling us what happened. We're going to analyze them using the accounting equation and figure out which accounts are affected. Then we're going to record those transactions in what we call a journal. And then we're going to post that to the ledger so we can see the balances in the individual accounts. From that, we can then prepare and analyze what we call a trial balance and then our financial statements. So let's talk about a little bit what those source documents are. Well, source documents are those things that help create those transactions. So there's always some kind of documentation when a transaction occurs. So it might be a receipt from buying a light bulb. It might be a check from someone who is sending you money for payment for something they've ordered. It might be a bank statement telling us what's occurred in our account or what charges they've given us. It could be a bill from a supplier that we've ordered something from. And there's tons of other things that can be source documents. Those are the things that help create the backup for the transactions that we're going to identify. So let's look at what an account is. So we talked before about accounts like cash, accounts receivable. We've talked about expense accounts like rent expense. We've talked about our capital account. And each of those is its own account, which is a record of the increases or decreases in a specific asset, liability, equity, revenue, or expense account. The record that we use of all of the accounts is called the general ledger. So we're going to have a general ledger that keeps all of the accounts and balances all together. All right, so when we look at the basic accounting equation, we had our assets equals liabilities plus equity. So that's what we're going to be looking at. Again, we're going to keep that in mind as we go through all the transactions. So when we talk about asset accounts, those are the resources that are owned or controlled by a company, and they have some kind of expected future benefit. So a lot of accounting systems that we're going to use separate accounts for the assets described. So we are going to have a separate account for cash, accounts receivable, notes receivable, and we might have even those prepaid accounts. Then under liability accounts, those again are the claims to creditors or the debts, and they're claims against our assets, which means they're obligations to transfer assets or provide products or services to other entities. So typically our creditors are going to use their balance sheet to help us decide whether they're going to loan us money to our company. A loan is going to be less risky if our liabilities are small in comparison to our assets, because that means there's more resources than there are claims on those resources. When we think about liability accounts, typically we're going to see that word payable in most of them, but it's not in all of them. Some of the common liability accounts are accounts payable, notes payable. We're going to learn what unearned revenue accounts are in Chapter 3, and then we have accrued liabilities also. And the last category is equity accounts. So equity accounts are the owner's claim on a company's assets. They're called equity or owner's equity. That's the same thing. And that's the trade-off that the owner gets for investing assets in a business. All right, so let's look at some more detail about these asset accounts. So again, assets are something that we own, and they have some examples here, and we've gone through some of them before. Just to touch on them, cash reflects the company's cash balances. It's going to include money that they have on hand, any funds that are in the bank. It might be coins, checks, money orders, checking account balances. All of that is going to be considered in our cash account. Then we have accounts receivable. This is when we have sold something to someone with a promise that they're going to pay us in the future. They're typically called credit sales or sales on account or on credit. Accounts receivable is going to be increased by credit sales on account. So when we sell to someone on account, our accounts receivable is going to go up and they're going to pay us sometime in the future. Then we have notes receivable. It's similar to accounts receivable except it has interest that's accrued, where accounts receivable doesn't typically have interest associated with it. Notes receivable also typically is going to have a promissory note where you're signing, acknowledging you're going to pay back a balance in addition to interest by a certain date. They list here prepaid accounts. They're also called prepaid expenses, and they're assets that represent prepayments of future expenses. So they're things that we know we're going to have to pay, and we're paying it up front. So when they occur later, then we will then expense it, and we'll transfer it to that expense account. So an example would be prepaid insurance, prepaid rent. And when you think about that, when you're moving into somewhere and they're asking for your rent, they're wanting that amount up front. Even though you haven't lived there from the 1st to the 30th, they want you to pay that month of rent on the 1st. And that's a prepaid amount. It would be expensed after you've used that space at the end of those 30 days. Then we have supplies. So for right now, until we get into chapter 3, we're going to assume that supplies are an asset that we own. And right now we're just buying them to use in the future. We are not using any supplies. We're just buying them and putting them on our property to use sometime in the future. In chapter 3, we'll look at how we actually use them and what the entry looks like for that. We have equipment listed here. Equipment, buildings, and land. Those are all things that the business owns. You can have land that has a building on it. We're still going to account for them separately. And then we have equipment listed also. Those are the things that you need to run your business. All right, let's look at the liability account. So I said before, accounts payable is going to be the most common. Liabilities are the claims against the assets by creditors. They have the right to get their payment, and if we don't pay them, they can sue us and we can be required to sell our assets to pay them. So the common liability accounts that are listed here is accounts payable. That's again when we promise to pay someone else later. So we're buying on credit instead of selling on credit and using accounts receivable. Now we're buying on credit. The next one is notes payable. So again, typically it has a written promissory note with a future amount that we're going to pay, including interest. Accrued liabilities are amounts that we owe, but we haven't paid them yet. So for example, we might get an electric bill. Well, we know we've incurred that expense, but it's not due until the 21st of the month. So we're not going to pay it until the 21st, but we want to put it on our books because we know we have it. That source document, the bill, came in. So we're going to accrue that liability until it's time to pay it. And the other one is unearned revenue. And again, it's a liability that's settled in the future when we actually deliver the products or services. So for example, if you subscribe to a magazine, you typically pay 1 year subscription in advance. For the publishing company, it's cash received, but nothing's been done to earn that revenue. So that's why it's called unearned revenue. As they deliver the magazines to you every month, they're going to recognize a portion of the money received as revenue. At the end of the year, all the revenue will be earned and the liability is no longer going to exist. All right, our equity accounts. We've talked about these before in chapter 1. Nothing in here is new. We have an owner capital, which is where it's going to increase the equity. We have revenues, which increases equity. Owner withdrawals and expenses both decrease equity. Revenue is when we've earned the money, we can recognize the revenue. Owner capital is for the equity that we give the owner for investing assets in the company. Expenses are what we pay to allocate or to operate our company. And then owner withdrawals, if the owner withdraws money for personal business, we're going to keep track of what they pull out. Just like we kept track of what they put in owner's capital, we're going to keep track of what they pull out under owner withdrawals. All right, so we talked before about the accounting equation, assets, liabilities, and equity. We even expanded it before in chapter 1 where we talked about capital, withdrawals, revenue, and expenses. So nothing new in that slide. All right, the next part we're going to look at is the ledger and the chart of accounts. So there is a chart of account in your resources tab, and I recommend reviewing that. What we're going to look at here is this is just a list of all the accounts. So a ledger is a collection of all the accounts, and it has their balances for all the accounts that are in our system. The chart of accounts has a list of the accounts and includes an account number for each account. So you'll see here that cash is typically account number 101. Accounts payable is 201. We get into the capital, revenues, and expenses, and we see that we have 301, 403, 622. So those account numbers help us to identify each of those accounts. Again, it's important to make sure that you review the chart of accounts that's been provided to you also. All right, so let's talk about some of the terminology that seems to come from things we think we know. So we've heard debits, the words debits and credits. We've typically associated it with banking. But for us, it simply means debit means left, credit means right. There's no other interpretation. What we're going to do is use something called a T account. It's going to represent our ledger accounts where we get the balances of each of the different types of accounts. And the T accounts just use while we're learning it. It's not what we actually use in a company, but it helps us as we're learning how to balance accounts. So the left side of the T account is always called the debit side. The right side of the T account is always called the credit side. So this goes along with what we call a double entry system. We're going to use these terms pretty frequently. The term debit or credit by itself does not mean increase or decrease. There's different rules that tell you whether to increase or decrease. So whether a debit or a credit is an increase or a decrease depends on the type of the account. The difference between total debits and total credits for an account is going to be your balance. So if you took your left side minus your right side, whatever side is larger, that's where your balance is going to be. If we had the sum of debits that exceeds the sum of credits, then it's going to have a debit balance, and vice versa. If the right side's more than the left, we're going to have a credit balance. All right, so I've said the word double entry accounting a couple of times, and I just want to kind of explain what that is. So we've talked before about we have to have at least 2 accounts that were recognized in every transaction. So in chapter 1, that's what we did. Every transaction that we analyzed, we had 2 different accounts. With that said, we're going to take it a step further, and we're going to have at least 1 debit and 1 credit. So 1 increase and 1 decrease. And this slide kind of shows you what the normal way to increase an account is. So does your cheat sheet that I provided in your chapter resources tabs. So what we're looking at here is just assets are going to increase with a debit, and they're going to decrease with a credit. And then we're also going to see that liabilities decrease with a debit, increase with a credit. Equity, this is a little misleading because it depends on the type of equity account, and I'll show you that in the next slide. So if we break equity down a little further, capital and revenues follow the same rule where they increase with a credit, decrease with a debit. Withdrawals and expenses follow the same rules where they decrease with a credit and increase with a debit. So again, that cheat sheet that I provided in the chapter resources tab is going to be really important because it's going to give you the summary of all of these rules and tell you how to increase or decrease an account using just the cheat sheet. It also tells you in here the normal balance that's also on the cheat sheet so that you know what kind of balance should you see in these types of accounts. So assets should have a normal debit balance, liabilities have a normal credit balance, so does capital and revenue. Withdrawals and expenses have a normal debit balance, so that's what we want to be aware of. All right, so what we want to see here is a T account. So what we're looking at is how do we get that balance? So if we have entries that we've debited on the left side, entries we've credited on the right side, we're going to take the totals and get the difference. That's our balance down here at the bottom. So just being able to use a T account is really important. We will continue in part 2 in the next video.